Our first speaker today, I'd like to introduce Wilbur Ross. Wilbur has been one of the real thought leaders in the analysis of the global financial system. He founded the W.L. Ross Company, and it's one of the leading value-oriented, global, active private investment companies. And so for the Yale students in this room, you also will know him from the Bank of Ireland case, which has been a part of our curriculum. Wilbur was generous enough to share his experience in an amazing workout deal in Ireland, and that experience became part of became the heart of one of our raw cases, as we call them at the school. So we've had a chance to really study the way that you've thought about and deeply analyzed the banking system there. He's going to talk about regulatory challenges and opportunities facing bank management, and so very much appreciate you being part of this. So welcome, Mr. Ross.
Thank you.
Yep.
Thank you very much. What I'm actually going to talk about is both IT and the regulatory challenges and opportunities facing bank managements. When I was a child, my mother often took me to the Dime Savings Bank on East 42nd Street in Manhattan. She put most of her savings there because no bank near us in New Jersey had such a spectacular building. The soaring 40-foot high vaulted ceilings, the Italian marble floors, the impressive oil paintings on the walls, and the acres of highly polished mahogany and brass desks proved that her money would be safer there than in our local bank. Therefore, she regularly traveled an hour and a half each way to make her deposits and to have them carefully update the accrued interest on the pages of her passbook savings account. How banking has changed. That building is now a catering hall. I go to the branches of our portfolio banks only to look at the internet lounges that we're building as fast as we can. Branches are becoming more like liabilities than like assets. Internet banking will obsolete them as the distribution system for most banking products. The most important benefits of smart banking are low cost and immediacy, neither of which needs extensive branch systems with large staffs. Competition among technology-based models will revolve around their relative functionality. It already is clear that physical checks are very inefficient ways to move money from one account to another, and Quicken and other firms have shown that internet processing of mortgages is effective. In addition, internet banks like Ally boast that they pay higher interest rates on deposits because they have no branches. For decades, bankers have dreamt about one-stop shopping, but have never been able to make it a reality. Smart banking probably is the solution. Frost & Sullivan has forecast, as you can see in the chart up on the screen, extremely rapid changes in both technology and applications over the next 5 years. The 7 forecast technological changes will drive 10 new applications. Most importantly, you'll notice that by around 2020, they believe that virtual branches will be reality. Matthew Wilcox, a Fiserv senior vice president, recently said that financial services strategy will shift digital banking from a self-service delivery channel to a full-service one, and shift mobile from cost reduction to expanding share of the wallet and becoming central to consumers' financial lives. These visionary forecasts are supported by Federal Reserve System data. Based on a December 2014 survey, 87% of U.S. adults had mobile phones, 71% of which are smartphones, up from 61% the year before. 39% who also had bank accounts used mobile banking in 2014 versus 33% a year earlier and 29% in 2012. But 51% of smartphoners did so, and 11% of the non-users expect that they will do so this year. 94% use mobile to check balances, 61% for intrapersonal account transfers, 57% to receive bank alerts, and 51% to deposit checks. Frequency of annual use per person rose to 60 times from 48 the year before. 22% of all users made a mobile payment last year, up from 17% in 2013. More surprisingly, 69% of those who comparison shopped by phone changed vendors, and of those who checked their bank balance when considering a big purchase, 53% deferred the purchase. Also surprising is that of the 27% of our population who are either unbanked or underbanked, 65% of them have access to smartphones. Hispanic smartphone usage went from 55% in 2011 to 82% last year, while penetration of Asian Americans grew from 45% to 83%. As you'd expect, 85% of people aged 18 to 44 with cell phones had smart ones, but only 43% of those over 60 did. Similarly, 85% of households earning over $100,000 had smartphones, but only 53% of those earning less than $25,000 did. A staggering 62% of those who did not use mobile banking cited security concerns as the reason why they were not using mobile banking. So in short, the most rapidly growing and affluent customer sectors are the best prospects, especially if they can be made to feel more secure. The bigger question is whether there will be a profitable business model for smart banking. If banks are too slow to embrace greater functionality, internet-based disruptors probably will destroy price structures. Disruptors' initial strategies are always to capture eyeballs rather than dollar bills. If they quickly gather lots of eyeballs, venture capitalists will provide them with enough cheap equity to cover many years of startup losses, and these providers are not burdened with the cost of existing branch infrastructure. They therefore are well positioned to compete with traditional banks. Even without disruption from newcomers, eventually all banks will have access to comparable technologies. At that point, innovative strategies will become necessary to try to avoid commoditization. My guess is that the first movers will gain a really strong competitive edge and that the laggards will lose market share, perhaps permanently. Smart banking has the potential to make the one-stop banking a reality, or perhaps more accurately, a virtual reality. Smart banking eventually will prevail because of cost efficiency, speed, performance, convenience, availability, and ubiquity. But many potential components of smart banking create new problems while they're solving existing ones. For example, cloud computing and hypercloud combinations of private and public clouds could deliver smart banking quite efficiently, but cybersecurity vulnerability increases every time you add possible points of hacker entry. Similarly, the Internet of Things could improve communication among networks of Internet protocol smart devices, but that multiplication of interacting entities would similarly add to cyber risks. The exponential growth of technology already has changed the nature of criminal activity against banks. The big crimes before were the relatively rare armed robberies, late-night break-ins, and insider theft from depositors. Now the issues are cyber attacks. Even smaller regional banks have hundreds of attempted incursions per month, and leading banks have orders of magnitude more. Banks typically have at least 7 firewalls and are constantly improving them. And banks also exchange data about new efforts by intruders. But hackers are becoming ever more sophisticated. And the fundamental problem is that bank security must be 100% effective, but cyber terrorists only need to succeed a small fraction of 1% of the time. Much of the vulnerability comes from the use of alphanumeric codes because people tend to write them down as memory aids, and that practice can result in inadvertent leakage. Also, anything transmitted wirelessly is subject to interception. In addition, most access codes have only 8 digits. Just increasing the number of digits to 10 would make it 500 times harder for someone to crack the code. But the new trend is toward biometric authentication, such as fingerprints, facial recognition, retina recognition, voice recognition, and believe it or not, even heartbeat recognition. There also will be more sophisticated and complex methods of encryption, plus predictive analytics to identify behavioral abnormalities in the network, possibly precursing cyber attacks. But experts say human error is the cause of 90% of hacking, and this is obviously hard to prevent with systems. Remember the World War II security poster, "Loose lips sink ships." That's exactly true of the help that loose lips give cyber hackers. The third issue with technology is regulation. The FCC already is interested in regulating some aspects of the internet, and the Officer of the Comptroller of the Currency has issued to banks a circular describing how smart banking will be incorporated into its on-site examinations. And it won't be long before the Consumer Financial Protection Bureau does so as well. All regulators will be especially interested in cybersecurity. And that comment is probably a good segue into a discussion of the overall regulatory environment. A combination of lax supervision, faulty modeling, and greed have caused great antipathy toward bank managements. Much of the blame is richly deserved, but part of it is an effort by the Congress, the SEC, and bank regulators to mask their own roles in causing the crisis. Congress enacted the Community Reinvestment Act to require banks to deploy some of their lending into less creditworthy communities, and every year required the GSEs to extend more and more risky credit. They literally gave them budgets for how much they had to do. Remember Congressman Barney Frank's famous remark, "I'm willing to roll the dice with Fannie and Freddie." Well, he did, and it came up snake eyes. After the crash, he co-sponsored Dodd-Frank, although I have yet to understand how Dodd-Frank would have prevented the subprime crisis. It did, however, create the Consumer Financial Protection Bureau, which is accountable neither to the Federal Reserve where it is housed, nor to the Congress which created it. It is the only government agency I know of that unilaterally sets its own budget. It also has no obligation to foster the solvency or profitability of the banks. In fact, to the degree that its consumer advocacy reduces bank profitability, its functions are directly contradictory to the safety and soundness mandates of the FDIC, the Comptroller of the Currency, and the Federal Reserve itself. CPFB was created because of the perception that borrowers were victimized by the subprime bubble and its bursting. But even with all the bad practices of mortgage servicers, such as the infamous robo-signing, there was not a single case of anyone being foreclosed out of a home without having a seriously defaulted mortgage. Not one case. Also, no one forced mortgage applicants to lie about their income. Finally, just as there were some predatory lenders hawking complex mortgages, there also were lots of predatory borrowers. A borrower who defaulted within 90 days after taking out a mortgage probably never did intend to pay it. And defaulters' lawyers used technicalities to thwart legitimate foreclosures. One borrower in New York literally occupied a home for 7 years without making a single payment on the mortgage or for real estate taxes. During the process, he filed for personal bankruptcy 3 times. He was a genuinely predatory borrower and is unique only because of the duration of his shenanigans. The other major subprime development is litigation by state attorneys general. They are not bank regulators, but repeatedly have brought class action litigations against segments of the mortgage and commercial banking communities and have extracted huge financial settlements. Finally, European and US regulators are competing as to which is the tougher. Now that the ECB has become the pan-European banking regulator, it conducts asset quality reviews to examine loan portfolios under status quo conditions and separately runs stress tests under pessimistic assumptions. If a bank fails, it must raise more capital, and in at least one case, the effect was to wipe out not only equity security holders, but also 40% of all deposits in excess of 100,000 euros. FDIC has not yet gone that far. FDIC normally has all deposits, whether insured or not, assumed by the acquirer of a failed bank. I believe that unless banks change the way they are perceived, both regulations and enforcement will become more severe. Bankers today are regarded as greedy, marginally competent elites who are out of touch with their customers. This is partly based on historic facts, so the banks need to change both their reality and the perception of their reality. Little things like struggling to have the CEO retain his position as board chairman hurt banks' images, however appropriate the idea may be for that particular institution. So do banks' hyper-performance-based compensation schemes. But banks actually do lots of good charitable work. But when has there ever been an article in the paper or a TV clip praising any good deed that a bank has done? If banks do not improve their perception, they'll be subject to more regulation and stricter enforcement. Already, the settlements arising out of prior misdeeds have led to the imposition of monitors at the banks. These monitors are paid millions of dollars per month to scrutinize the most minute and inconsequential details of operations. Their entire purpose is to find gotchas. And when you are dealing with millions of transactions, there of course will be a number of errors every month. These are then reported in great detail and justified the continued retention of the monitor. The monitors do not replace historic regulators. They are in addition to them. The other bizarre practice in resolving prior bad acts by the banks is that the institutions pay huge fines, but rarely are the individual perpetrators fined or imprisoned. These practices punish the shareholders who had nothing to do with the offense, rather than the executives whose job it was to make sure that things were done properly. These fines also have come directly out of the bank's equity capital and therefore reduce the base needed to support lending. The $100 billion plus of fines probably would have supported another $1 trillion of loans. Regulatory compliance is so expensive that many small banks have sold out. This is one reason why there are 4,000 fewer banks now than in 2007. During the same period, the combined deposit market share of the three largest banks has gone from 22.4% to 35.6%, and the share of the four largest has gone from 26.8% to 40.7%. So much for all the concerns about too big to fail. What are the implications of banks' regulatory problems? Increased costs, elimination of some profitable businesses, and expanded capital requirements will limit the returns on equity that banks can achieve. At a recent bank CEO conference, the moderator asked what return on equity each CEO expected during the next 5 years. About 30% said 8% or less. 31% said 8% to 10%. Another 30% said 10 to 12, and only 9% expected more than 12%. If this pessimism proves correct, it seems likely that a majority of the banks will have their shares trading at less than their book value. Regression analyses over long periods of time show that only banks earning more than 10% on equity consistently trade at premiums to book value. This is significant because raising new capital at a discount from book value obviously dilutes present holders, especially if the new capital also is invested at sub-10% rates of return. Such banks will have difficulty accessing the capital markets. And this scenario suggests that in their quest to make banking safer, government has made it unattractive to investors from whom new capital is needed periodically to support growth. If banks cannot meet the financial needs of the economy, shadow banks will continue to expand, at least until they in turn are more severely targeted by regulators. Under this hypothesis, the growth rate of regulators will greatly outpace the growth rate of the financial system. Bank regulatory pressures also have resulted in a reduction of the capital available on both debt and equity trading desks. This indeed reduced the risks to banks, but it merely transferred the risks to the public. Oliver Wyman estimates that trading desk reductions have shrunk bank balance sheets by 20% since 2010, and that another 10 to 15% shrinkage is likely. Since there was no capital transferred along with the risks, the end result is greater volatility in trading markets. And it's not at all clear that this is beneficial to the economy. Highly permissive conditions in debt and equity markets have minimized the impact of reduced liquidity until recently, but the full effect will be seen as rates normalize. The combination of compliance costs and extra capital probably mean that over the longer term, interest rates will have to be 50 to 75 basis points higher than otherwise, simply in order to keep bank returns on equity constant. Given the recent hysteria over a potential 25 basis point increase in lending rates, this wouldn't be good for markets or for the real economy. The larger question is whether the increased costs are justified by improvement in the functioning of the banking system. Regulation likely will suppress product innovation, and given the experience with subprime, one could argue that less innovation might actually be better. But other innovations, such as credit cards and smart banking, seem very beneficial to consumers. Another question is whether the result actually will be a sounder system. Most of the new rules would have done nothing to prevent the subprime crisis. Better regulatory supervision and better enforcement could have done so. Also, the history of the institutions most heavily controlled by government is not encouraging. Fannie, Freddie, the FHA, and student loan programs all have been disasters. And there's a reason for that. Politicians have an innate tendency to use lending as an instrument of societal reform, and doing so inevitably leads to more non-performing loans. Government policy for decades has favored borrowers over savers, and this often has led to the wrong people becoming the borrowers. Over the last dozen years, the top 5% of earners in this country have reduced by 50% their ratio of debt to income, while the lower 95% have doubled their ratio of debt to income. Worse yet, the deficit net worth of the poorest 20% of our population went from $10,800 in 2001 to $15,200 in 2007, and now is $25,000 as of 2010, because they borrowed extensively to buy assets like cars, furniture, and TVs that depreciated rapidly in value. I hope that this brief analysis of the implications of technology and regulation for banking are at least thought-provocative, and I'll be happy to answer a few questions if you don't make them too hard. Over here.
Hi, Wilbur. My name's Kevin Murphy. I'm a senior fellow at Harvard. Sorry about that. trying to bring both parts of your presentation together. There's a lot of innovation in the technology that you're suggesting is on the horizon with banking, okay? But then again, the second part of your presentation suggests there's a headwind on regulation, okay? So trying to reconcile both parts of your presentation, how could changes in regulation assist the innovation and technology in banking?
I don't know that there's a role for regulation to improve the accessibility of technology. My hope is that it won't become an interference with it. The wheels are already in motion to have big technological change. But until we, to some degree, get over the notion that you can somehow legislate away human error, it's going to be hard to keep regulation from getting to where it thwarts growth. Internet has grown at an enormously rapid rate without regulation. And while there certainly are questions of privacy, there are certainly questions of identity theft that are very serious, everybody's aware of those on a commercial basis. It doesn't even need really more regulation to be sensitive to them. The incursions that have taken ID from commercial entities have been costing millions and millions of dollars. So there's plenty of incentive to deal with cybersecurity, but I'm not aware that there's any way you can legislate hackers out of existence. Couple questions over here. Okay.
Hello, Mr. Ross. Thank you for your insightful presentation. My name is Wahid Zafar. I'm a high school sophomore, and I'm wondering, if we look at the industry today, Citigroup is working on a new cryptocurrency called Citicoin, and NASDAQ is investing in blockchain to keep track of stock ownership. What implications does this have on banking regulations?
Well, bitcoins, if I get your question right, are a very hotly debated topic, both from the part of regulators and on the part of people in the financial industry. There's an interesting intellectual question which I don't think has really been resolved, and that is this an alternate form of currency, or is it a speculative security that's being traded? And depending on how people answer that question will have a lot to do with the extent to which and by whom it becomes regulated. My own concern is that while the Bitcoin people feel that their algorithm is so sophisticated that nobody can ever replicate it, I'm not so sure that there isn't some teenage kid, maybe you, in a garage figuring out how do you replicate that algorithm that lives up in Iceland. So there are a bunch of questions.
Yep.
Oh, okay, over here.
Thank you for your presentation. Nate Dougal with Netherby Advisors. Just a quick question on Dodd-Frank's impact on the community banks and, in a broader sense, the impact on the consumers Dodd-Frank was meant to protect. Thanks.
Yeah, it's been very severe on community banks. If our math is right, we doubt that community banks with less than about $1.5 billion of assets can survive. Many of the smaller banks literally now have more compliance officers than they have loan officers. That's not a successful business model. So it's put terrible pressure on the community banks. There are moves afoot in the Congress that you're probably well aware of to try to soften some of the regulatory burden on the very small institutions. And I hope that that will succeed, because the community banks have really been quite core to small business, local real estate development, and individual customers over the years. And I think it may be not a total coincidence that the change in new businesses starting versus businesses folding has become negative in recent years, more or less concurrently with the demise of so many community banks. That's certainly not the only reason, but I do think it may be a contributing factor to it. So I think that the likelihood is that you're going to see much more consolidation. Probably another 1,000 or 2,000 banks will go out of existence or be merged over the next few years. Well, there are a lot of hands over in here.
Good morning, Mr. Ross. Thanks for a great presentation. My name is Katie Ching, SOM class of 2005, and also founder of Crimson Ivy Capital Partners. In your presentation, you pointed out that smart banking is unstoppable. It will happen. It's happening really rapidly, and it won't stop. And second part of your presentation pointed out, sort of alluded to the point that regulation needs to stop. So wouldn't it be fair to say that the more virtual reality banking happens, the more access points there are for regulators to do everything that they want to do that we don't want them to do?
I don't know that there are more access points for the regulators, because all the functions of banking, they already have regulatory access to. This is really just changing the delivery system for them. But it certainly is true that every time you add a point of entry, you give another potential for hacking. That for sure is true. I think the difference, what the regulators probably are going to focus on initially is really the cybersecurity aspects, because identity theft is such a hot button. You saw the statistic that over 60% of the people who don't use smart banking don't do it, don't use mobile banking, don't do it because of worry about security. Well, that's a big portion of the public, and it's a legitimate concern. There have been these enormous data thefts, and I think they're right to try to deal with it. But again, the problem is, how do you legislate things like that away? I don't know of any legislation that will really make hacking harder. Maybe if they put bigger penalties on it or something like that would help. But hacking is going to exist till time immemorial, and will become bigger and bigger as there's more use of wireless. Anything that's over wireless is interceptable. Okay.
Hi, Victoria Brenner, former SOM student. Wanted to ask you a question on the perception of banks. You started out your presentation that your mom went to a bank because it was so beautifully done that she felt that her money was safe there. Then the banks became these buildings where it was all about transparency with glasses and windows, and you could see in there. Why do you think the banks are not doing a better job at their own PR? Why are they paying out all these fines versus spending money on making sure that it's heard that they're doing a good job in every level?
Well, it's a good question, and I'm not sure anybody has a really good answer to it. I think my own feeling is that the issue shouldn't be defined as, are banks too big to fail? I think the issue should be defined as, are they too complex to be managed? And I think complexity of banks, particularly the so-called universal banks, maybe has gotten to the point where it is extremely difficult to manage. There are lots of reasons that seems to be true. One of them is, if you're a global bank dealing in hundreds and hundreds of different kinds of products in 100 or so different jurisdictions, you're inevitably in the process where you have to keep moving mid-management around from one place to another in order to give them the overall grounding. Well, what does that mean? That means that a lot of your middle management at any point in time will be on-the-job training. And if these are really complicated products, maybe that's an inherent flaw in the system in and of itself. The other thing is that I think that technology has not been given as high a priority by the banks as it should have been, and I surely don't think PR has been given the priority that it should have. But if you think about other consumer product companies, the retailers do a much better job projecting their images than the banks do. So I think a lot of it is a mindset. But I think there's another reason. Once you're in a regulated industry, there will be infractions of the regulation. It's just inevitable because you can't legislate honesty into people. You can try to protect against it, but you can't effectively legislate it. So as the products become more complex, it does become more difficult to manage them right, and it just makes for more problems. So I think that they can do a more careful job. I'm not sure that that all these monitors are going to be very effective, but it's a real question for management to grapple with, particularly since they're simultaneously going to be facing how do they adapt to all this new technological innovation. That's a big set of challenges, to have both existing regulatory challenges and the challenge of redoing fundamentally your business model. So it's going to be interesting to see whether the combination of those two doesn't create a whole new series of winners and losers in banking.
Diana Harrington from Babson College. Your data is very strong and very persuasive, except I don't agree with your implications.
Well, good. We can have a debate then.
Yes, we could. But there are two reasons why. The first is that in terms of the way you see a bank, you see it as a mechanism for transactions. And I think that banks are much more than a mechanism of moving money from place to place. They're a place where people can get guidance for how they deal with money, how they deal with large expenditures. So that's one of the things. The second thing is that banks clearly in other countries have different models that they work on, and some of them won't work on the kind of model you're talking about. And those are banks or those are countries where the culture of the country has a different relationship to the banking system. I'll give you an example from the 1980s. In the 1980s, if you had the banking system in Colombia was almost exclusively arm's length, lots and lots of ATMs all over the place because people never knew when they would be hit for money by random ATM bandits. So that there was a lot of electronic banking, at least hands-on electronic banking. At the same time, at the same situation, Mexico could have had the same sort of situation. But Mexicans at the time, and probably to some degree now, want to know their banker face-to-face and personally. So the question is, my question that's at the core of what you've said, is banking just about transacting money?
Well, I think it's a good theory that the banks could be investment counselors to every retail customer, but the reality is that they would need 10 times the staff if they were really to do that effectively. So I despair that at the small retail level, which is probably where it's needed the most, I despair that would ever become a reality. It's not a service they could really charge for in any event. What I think is more necessary and could help solve the problem would be if there were incorporated into the educational curricula of the school systems much more about how money works, how the financial system works, and giving people some ability to deal with it. I think that would be a much more constructive use, and then perhaps could be supplemented to some degree by the bank people. But most bankers are frankly just not going to be able to spend the time to be a real family counselor to small individual accounts. To the private wealth people, sure, they'll do anything. They'll get your kid into prep school. They'll do whatever they can think of, but not at the small retail level. You do make an interesting point, though. In the developing countries, in many cases, a higher percentage of the population has mobile phones than has bank accounts. Places like Vietnam, for example, that's true. And in parts of Africa, it's also true, partly because the landline systems never really got built. So in those places, in some ways, the advent of mobile banking is farther advanced than it is even here. So I take your point that there are cultural differences, but I don't think that's going to slow down the advent of smart banking.
Hi, thank you so much for your presentation, Mr. Ross. My name is Helen Inides. I'm an executive MBA student here at Yale, class 2017. I've been in retail financial services, retail banking for 15 years, 8 years as branch manager. Just a few comments. Although I do see us going into the mobile banking, and I see it every day, some of the strategies in my company are to take our customers and use the mobile services that we have through digitalization. I do see apprehension from our customers. A lot of our customers do like going to the teller, just as you were going with your mom to that branch on East 42nd Street. I also see some challenges that our senior management team has in reference to trying to enhance our mobile technology. They come into a lot of regulatory aspects, and sometimes it slows down our ability to enhance our mobile technology. So there's a lot of different things coming through, but I do agree with the comments from, I don't know her name, I apologize. I do agree with the comments, but also our banking centers are becoming advice centers in a sense, and we're trying to advise our customers on how to bank or what they can do to build their wealth. So there's a lot of different aspects, and I see it daily. But the regulations, to me, need to be a little bit more flexible, and I think that's where you're right, because that can stop the technology from moving forward.
Okay, is there a question in there?
No, I think I want to say that I agree
Okay.
with you on the regulatory aspect.
Thank you.
Hello, hi. Thank you, Mr. Ross, for the presentation. My name is Eddie Tam, class of 1993, actually. I live and work in Hong Kong and in China. I was just wondering, I mean, I think internet finance is a lot more than just smart banking, right? In fact, I mean, going through the last crisis or ongoing crises in different countries, it seems to me that the fundamental problem of banking is not just the technology of it, but it's the fractional banking system. It's the fact that, by definition, banks are highly leveraged. So to make up for that, then you create moral hazard by creating deposit insurance and so on. So through internet finance, doesn't that create a further opportunity for disintermediation? You know, things such as P2P lending and other types of direct financial services, whereby you cut away the highly leveraged middleman. And if you are successful in doing that, perhaps you can also do away with a lot of the, over-regulation that you were talking about. So isn't it kind of like a circular question that we're looking at?
Well, P2P lending, peer-to-peer lending, has yet to be proven as really working. It's, I think, more of a concept than it is a reality. And the real issue will come up as people start to experience credit losses in the peer-to-peer lending. How far will it really go? The thing about the bank is it is the place in between savers and borrowers, and it's the one who makes the credit judgment and takes the loss. So agreeing with the lady from Babson, most private people are not remotely qualified to judge a credit risk. They probably don't even have a good comprehension of their own credit risk, let alone lending to other people. So I'm a little bit of a skeptic as to how well peer-to-peer will do when applied on a big scale.
Last question.
I'm Shyam Sundar from School of Management. Thank you for your excellent talk. You mentioned the cybersecurity against hackers. My question is, can banking be effectively audited against internal fraud and malfeasance to create a basis for a trustworthy system? And if so, how?
Well, as I say, it's impossible to legislate or regulate good judgment and honesty. That just can't be. You can have all the systems in the world. There will be some incident of internal fraud. There's no question about it. All you can try to do as management is to minimize it and to deal with it severely when it does occur. But the idea that somehow you could somehow get a perfect system and nobody would ever do anything wrong, I think is a much larger societal question, and I've yet to find an answer to it either in the big societal picture or in the micro picture of the banks. I just think that's something we have to live with. It's part of being a human. Now, this gentleman here was very persistent with questioning. Nobody ever gave him a mic. Could we take one last one for him?
Thank you very much, Mr. Ross. An excellent presentation. And I'm Claudio Brocado from Ashton Capital Management. To some extent, the developments that you talked about have slowed arguably even reversed the secular trend towards globalization in retail banking. Do you think that will resume, that trend will resume, or the regulatory overhangs here, as well as in other major economies, will that basically prevent globalization to ever take place in retail banking?
I think you're going to see more and more consolidation in other parts of the world, not just in the U.S. The U.S. is peculiar in that we're one of the few countries that had combination regulation and charter granting of local states and federal. And that's why we've had many more by number of institutions than any other country that I'm aware of. So our particular system has its own unusual history. But if you look at Europe, the market share of the 3 and 4 and 5 big banks there has actually gone down since the financial crisis, not up. So there's a different trend there, but there is there, as here, consolidation among the smaller banks. You've seen it a lot in Spain. You're about to see a lot of it in Italy. You're probably going to see some of it in Greece as well. The financial crisis tends to result in M&A activity.
Thank you very much.
Thank you. Thank you.